right, welcome back. Bruce Porter joins us now for this week's Dollars and Cents segment. Teaches all about our money and how not to mess it up. Good to see you, Bruce.
Yeah, that's always something we learn every day.
That's true.
That's right.
Those things you wish you hadn't done, you go, boy, that was a good lesson. All right, we're going to talk about the basic rules for investing for the novice investor, someone who's just getting started. It can be a little bit overwhelming because I think people sometimes think, you know, I'm not pulling in a fortune here. I don't have a lot of money just to get by with, much less to invest. How do you get started?
Well, you know, there's 3 rules for somebody to follow that's just starting out, and it's real basic stuff when you think about it. Warren Buffett once said, my favorite holding period is forever. Now, the reason he feels that way is because what's one of the basic mistakes people make? They buy high, sell low, and they try to think, well, I'm going to buy this today and tomorrow I'm going to sell it. And all of a sudden, this novice investor thinks that they can start timing the market and things like that. So there's a lot of wisdom in that particular statement, because if you buy for value and hold, then you establish, why am I buying and why am I investing?
Right, so, and have an expert tell you when you've held a little too long and maybe it's time to change, because maybe you do need to divest
that leads
yourself.
into the today's segment. I mean, you got to pair the right investment and a combination of investments with whatever the objective is. Now, that also will have its own timeline and it'll have its own accumulation number. So when you're trying to figure out how much money am I going to need, when am I going to need it, how much risk I'm willing to take, things like that, that's what it takes in order to start your investment business.
Right, and it all goes back to what your objectives are, whether it's helping your kid go to college or retirement or paying off your house or whatever it is.
Right. So the first rule, and we're going to do this over 3 different segments, 3 different weeks here. The first rule we're going to cover today, and it's adopting a long-term perspective to your investment philosophies. Now, what's that mean? Well, let's break it down to where it's easy to understand. Let's say we're going to buy a house in 3 years, or let's say you're going to put your kids through college, and you've got 11 years before you need to do that. Or one day we want to retire, so we got 30 years for that. So if you think about it, each one of those objectives has a different timeline and a different accumulation number. So when you think about it, how am I going to apply different types of investments to each particular one? Well, if you're going to buy a house in 3 years, and let's say you've got $10,000 today, but you need 20. Now, are you going to put that in a super risky investment and try to double your money as fast as you can? Well, granted, you need $10,000 more dollars, but are you willing to accept the risk and the chance that if that doesn't pay off, you're not only going to lose your money, you may lose your ability to buy that house.
Yeah, it's true.
So when you're trying to establish how much risk I'm willing to take, and you know, it's a risk perspective that you can look at. Well, you got to consider those things, because you're probably more willing to take more risk for retirement money that's 30 years down the road than you are for money that you're going to need in 2 or 3 years.
Right.
And it all kind of makes sense. It's common sense.
Yeah,
right?
it is. But it helps to have an advisor tell you that. You need to think about how long we have here and how much of this dice you're willing to throw on some of these things.
Well, and sometimes more risky investments don't necessarily pay what a less risky or a more conservative investment that would give you systematic growth over a period. You know, say you only accumulate $15,000 in 3 years. Well, that's better than having $5,000 if your risky investment doesn't pay.
That's true.
So those things have to be considered, regardless of your confidence in your risk level that you're willing to take. You still have to establish the accumulation goal and your retirement.
And over the next 2 weeks, we're going to continue this conversation. But
Absolutely.
You are giving away 4 tickets to the Cardinals home opener. How can people win these?
All right, you go right there. You go to our Facebook page,
the Resource Center.
And like and share us. Visit us on our website. Take a look. We redid our website this year. And then tomorrow at 4 o'clock, we're going to pull 4 tickets. So one couple that wants to take a couple or 2 couples, not sure how we're going to do it, but we're going to give away 4 tickets tomorrow.